Okay, welcome to today's lecture. And we stopped last week with our discussion of options, and we've already talked about forwards and futures. And we'll now turn to swap contracts. Again, apologize for the still in slides that are still in German, but maybe it's instructional to have the slides in German and the lecture in English. What is a swap contract? A swap contract is, as the name suggests, a contract in which you swap usually fixed versus floating rates. For example, you can swap a fixed interest rate versus a variable floating interest rate, or you can swap two currencies, for example, euros against dollars, euros against Japanese yen. And if you are looking at an interest rate swap, it's quite clear it's usually the swap of a fixed interest rate versus a variable interest rate, or variable against a different variable interest rate. Then this is a swap contract. Usually swap contracts are OTC, meaning that you will look for a contract partner, institutional investor, investment bank, and both parties will agree on specific contract details that lay out the mechanism of how these payments are swapped. Now, let's turn to some very plain vanilla interest rate swaps. First, we'll have a fixed floating interest rate swap. In this case, you will pay a fixed interest rate, for example, 5%, and you will get a variable interest rate payment. And the cash flow streams that originate from this are also very simple. Usually you will pay, let's say, 5%, minus 5%, minus 5%, and you will get a variable interest rate. And this is, for example, the cash flow stream for the buyer of such a fixed floating interest rate swap. Now, one can imagine that the question now is what price should be attached to this contract? Who is profiting more from this contract? And for this, we need to price the swap, and this is actually quite simple. You simply look at the present value of this cash flow of the minus 5, minus 5, minus 5%, and you look at the present value of this variable leg, and we call these two the two legs of the swap. You need to look at those prices, P1 and let's call it P2, and obviously if P1 is larger than P2, the side that is getting the variable payment needs to pay the difference to the other contract partner, and vice versa. So this is a plain vanilla fixed floating interest rate swap. If you swap two variable interest rates, this is what we call a basis rate interest rate swap. So in this case, you're exchanging variable against a different variable interest rate. Then you can take an interest rate swap, and you can distinguish several varieties and several variants of such an interest rate swap. For example, you can look at an amortizing swap, at a forward swap, at a swaption, at an extendable swap, at a callable or a puttable swap. And all these are variants of the same idea, of the same concept. You want to swap interest rates, and in contrast to a plain vanilla swap in which both parties agree that they want to swap, for example, a swaption is the right to enter a swap contract, but not the obligation to do so. A forward swap, also sometimes called a T+S forward swap, simply means that you agree now to enter a swap contract in, say, 5 years, and then have a contract maturity of another 4 years. So the swap contract will expire in 9 years, but it will also only start in 5 years. So that's a forward swap. So you're not starting today in t = 0, but you will have the swap starting here in T, and it will run until S. And that is a T plus S forward swap. Okay, and callable and puttable swap, okay, that's also quite clear, I think. In a fixed floating interest rate swap, the so-called fixed rate payer, or just the buyer of the swap, pays fixed interest rates and gets variable interest rates from the floating rate payer or the seller or the receiver of the swap. So this is important to note, because in a swap contract one cannot really say that one party is buying or selling, because one side is paying, even in an exchange rate and foreign currency swap, it makes even more sense. Both parties are buying and both parties are selling. They are just buying and selling a different currency. One party is buying dollars, the other is selling dollars. So it is not quite clear first who is the buyer and seller of the swap. But in interest rate swaps, the common ground here is that the contract party that pays the fixed interest rate is the buyer of the swap, and the other party is the seller. Okay. Now, interest rate swaps can be further differentiated according to the origin of these payments. Now, usually you will enter a swap contract because you are getting, or you are receiving, or you are paying fixed or floating rate interest rates payments. And in some cases you have an asset that pays out interest rates. In some other cases you have a liability. For example, you have taken on a loan and you have to pay interest rates on that loan. So we are distinguishing liability swaps and asset or liability swaps, depending on the question from which underlying assets or liabilities those interest rate payments come. And on the next couple of slides, you can see that, for example, here we pay fixed interest rates, we get variable payments, and this is the basic structure of a swap. Might also be with an intermediary in between. In a liability swap, both parties have a loan, both parties pay out interest rates, but the first one is paying out variable interest rates, the other, B, is paying fixed interest rates, and they want to swap those interest rates, and this is a liability swap. So both interest rate payments are actually liabilities. They have to pay variable payments and fixed payments, and they are swapping it. With the asset swap, it's just the other way around. Both have given out. This is the asset swap. Both parties have given out a loan, for example, and they are receiving fixed and variable interest rate payments. Then again, they can swap those interest rate payments, but now, of course, it's the other way around. Here, we're getting variable payments here, and here we are getting fixed interest rate payments. And this asset or liability swaps, it simply shows you from which underlying financial contracts those payments originate from. And then, of course, you can also construct something that is called an asset liability swap, meaning that one party has an asset, the other has a liability, and again, they can swap interest rate payments. And this might make sense. For example, here, we have someone who's getting fixed payments, but he's actually interested in variable interest rate payments, and then he's just swapping it with someone who has to pay out variable payments, fixed payments, and they just go over B to the creditor. Okay. I told you that you need to price both legs individually, and it's quite simple to actually price those legs. Now, let's assume we are paying 5%, minus 5%, minus 5%, and we have to come up with a price, with an arbitrage-free price of such a leg of the swap contract. How would you do this? Quite simply, if we are the fixed rate payer, this is what? This is a combination of a coupon bond and a zero bond. How does it work? We'll do what? We'll pay out -5%, -5%, and -5%, and actually we'll also pay out -100, the notional. Let's make it not with percentages. Let's do it here. We are paying out -5, -5, -105, and this is a very simple coupon bond short. Okay. We are only interested in -5, -5, -5, so what do we do? 0, 0, plus 100, and this is a zero bond long, and we just know that in sum we have -5, -5, -5, and we need to go short here. This is a coupon bond, and we need to buy the zero bond, and the price difference here, or the combination of these two instruments, should yield the price of the fixed rate payer leg. This is meant by Geldmarktanlage long, Festzinsanlage short. You simply take a zero bond and a coupon bond, and you combine it. The floating rate payer, again, is slightly different, actually. I have to be careful here. This is the price of one leg. On this slide, here with the Geldmarktanlage, Festzinsanlage, this is the idea to price both legs at the same time. Now, what I meant here is, obviously, your position, if you are buying it, your total position is -5% plus V%. And this is the same idea. It's just the combination of -5, -5, -105, and plus V, plus V, plus 100, plus V. Yeah. If you usually Geldmarktanlage and Festzinsanlage, the distinction can be made that these are variable and fixed income products. For example, a coupon bond with fixed interest and fixed income versus a floating rate note, a floater. Yeah? And usually an investment on the capital market will be a floating rate note. Now, you can do it both at the same time. If you only want to price one leg, you would do this. You would combine, for example, a coupon bond with a zero bond. And, of course, you can do the same here for the floating rate pair. You will just use a floating rate note. And combine it again with a zero bond. Yeah? Short, now this time. And then you would get the floating rate pair leg, and the difference of the two would then again be the price. Yeah? And in this instant here, obviously, the price for the fixed rate pair, if it is positive, it has to be the negative price for the other contract party. Again, remember, it's an option. It's not an option, but it's a derivative. A derivative is always a zero-sum game. Meaning, if one contract partner is making a profit of €1, the other party is losing €1. And obviously, the price for the value of the swap contract to the fixed rate pair is the opposite to the value to the floating rate pair. Now, what will usually happen? In these examples here, we've simply fixed the fixed rate payment at 5%. And obviously, if we just fix it at 5% and we have a variable interest rate, it will happen that here the swap contract will have a positive or negative value to one or the other side. And usually this is not how it is done in practice. What you will do is you will make sure that at the start of the swap contract is worth 0 to both parties. And how do you achieve this? You simply fix this 5% here, which we refer to as the swap rate. You simply fix the swap rate in such a manner that both legs do currently not make a profit. Yeah? And obviously with variable interest rates, with market interest rates at almost close to 0%, we will not take the swap rate at 5%. It will probably be 0.1 or even 0%. Okay. Some market conventions for swap contracts. As I've said, you will usually fix the swap rate in such a manner that there is no payment necessary at the start of the swap contract, so it is worth 0 to both parties. And you need a date count convention for making sure how interest rates are fixed, how they are paid out. And you can see some examples for date count conventions here: actual 360, 30, 360, 30, 365. Simply it's a fiction that, for example, every year is 365 days or 360 days, and each month has, for example, 30 days, or you take the actual number of days in a month. So these are fictions, and these are simplifications to make the calculation of interest rates slightly easier. This is the swap rate, in German Swapsatz. It includes the reference interest rate and a swap spread. And these swap rates are published by banks, for example. You can observe those swap rates on the market. Just with any derivative and any financial instrument and contract, you can observe both a bid and an ask swap rate. Meaning that in this case, you will have to take the bid swap rate to enter a swap contract as the fixed rate payer. So if you buy a swap, you will have to pay the bid spread, bid rate. And this is interesting. I might have mentioned this before. In derivative markets, you can observe something like liquidity. Yeah? For example, if we now form a financial market and I want to enter a swap contract, and no one of you is willing to enter a swap contract, for example, as the floating rate payer, I cannot buy a swap. Then the market is illiquid. If each and every one of you is willing to enter such a swap contract, the market is liquid. And even though you cannot really say that you are buying a derivative in some cases. For example, with a swap contract, we are simply swapping payments, and you are not really buying something. Both sides are buying something. Even in this case, you can observe liquidity. However, the role liquidity plays in derivative markets is not as clear as it is in equity markets. In equity markets, it's quite clear. Even in bond markets, I'm producing assets, I'm producing financial instruments, and they are just lying around, and as the market is in positive net supply, someone has the ownership of those stocks, and he can always just keep it in his or her portfolio. But with the derivative only comes into existence as soon as I found someone who is willing to enter a swap contract. So it is not really clear theoretically how liquidity and liquidity risk will work. Yeah? In equity market, it's quite clear. If I'm the owner of the stock, liquidity is important for me because I need to sell it at some point. So I'm profiting from liquidity, and liquidity risk is bad for me. But if I sell it, I no longer have liquidity risk, and someone else has liquidity risk. Now in derivatives markets, this is not clear because the contract itself only comes into existence as soon as we have two parties. And then if the contract only comes into play and into existence as soon as I found a counterparty, then liquidity risk can be detrimental to both of us. Yeah? I might want to go out, you might want to exit the contract, and the direction of this effect is not clear ex ante. Okay. And with swap contracts, it makes sense. This is a standard interest rate swap, a plain vanilla interest rate swap, for example, a fixed floating swap. The reference interest rate is the 6-month Euribor, the London Interbank offered rate. The notional is constant over the lifetime of the swap. And you can see, never search and delete in a slide when you are not really done with translating the slides. The fixed interest rate payments, they are equivalent to the market level of interest rates, meaning that the swap rate is fixed in such a manner that no additional payment is necessary at the start or the end of the swap contract. Why? Why do you think usually market participants will fix the swap rate so that no additional payment is necessary? Think like a risk manager, because these contracts are usually purely done for risk management purposes. You're not interested in a huge capital expenditure. You're not interested in piling up capital and binding capital in a contract that is not for investment, it's only for risk management. So why use capital when the hedging effect is achieved by any swap rate? Because right now no one is making a profit. The effect is the same if we fix the fixed rate at the swap rate at 1, 5 or 20%. It will only increase the capital necessary to enter the contract. So simply reduce it and fix the swap rate such that there's no additional capital needed to pay now and to get back later. Simply fix the swap rate such that no additional payment is necessary. Is that clear? Yeah. Because otherwise the hedging effect would be the same, but we would have to pay now 1 million upfront and we'll get back 1 million plus minus a couple of % later on at the end of the contract. And that's not necessary. Okay. I've already told you how this is done. You simply have to price the fixed and the floating leg of the swap. Then you can get the fair swap rate. This will be done more extensively in a future lecture on quantitative risk management. And I've already shown you how this works. You have to take the price of a coupon bond and you have to take the price of a floating rate note, of a so-called floater, and the difference in the price, in the fair price of such a floater and the coupon bond then is the fair price of the long pair swap, if the swap rate is not fixed such that the price is 0, of course. Okay. And why are you fixing the swap rate and not the variable payment? Any idea? Because the variable payment is obviously variable. It's if you take the LIBOR, you cannot change the LIBOR. No? So the fixed rate, the 5% or the 6%, that's something you can fix for the whole duration of the contract. Okay. You can do hedging with interest rate swaps. You can try to actively manage interest rate risk. Actually, you can speculate with it. On the next couple of slides, this is shown how you can exploit some expectations on the interest rate. And I would guess that in some scenarios, you can definitely expect interest rates to go into one direction or the other. For example, right now, I would expect market interest rates can only go up. No? They will not go down any further. The question, however, is when will they increase? Okay. Just a couple of examples, and I think you can, it's best to look at those slides and those figures here. You have an investor who has bought something that pays out 5% fixed. And then you can do an interest rate swap. You will pay the 5% to a financial institution and you will get a variable payment back. Why? This is interesting. You have to be careful when you think about interest rate risk. You will have interest rate risk both with fixed and with floating rates. Why? Imagine you're a bank. You've given out a loan and the loan pays out 3%. Now interest rates drop. Then you're in luck. You have given out a loan and you're receiving 3%. And the current market price is, market interest rate is 0%. Okay, so with a fixed interest rate, you have interest rate risk. Because obviously, the fair price of this investment is calculated based on market interest rates, and you have to discount your future payments by using the market interest rates, and obviously then in this case, in this scenario, the price of the loan will go up. But if you've given out a loan, let's say right now at 1%, and market interest rates raise to 10% due to opportunity costs, you are getting future payments at a way too low interest rate. And then the price, the fair value of your loan will decrease. Same with insurance contracts. This is something life insurance companies right now have. They've long-term contracts and they have to pay out 3–4% on their contracts, and they are not making enough interest, not enough return on those investments. So it's quite clear with a fixed interest rate that you have an interest rate exposure. Now with a variable interest rate, you do not have this immediate risk exposure because you are discounting with the variable market interest rate, and you are also getting and receiving a variable interest rate payment. So the price should not vary. But of course, if you are neglecting opportunity costs, it's quite clear that if you are getting a variable payment and you've given out a loan, for example, with a variable interest rate payment, and interest rates go down, your future payments will also decrease and you will get lower interest rate payments. In this case, I have 5% fixed and I want to hedge against my interest rate risk, and I'm doing an interest rate swap. Now let's assume market level of interest rates goes up and we are expecting interest rates to increase. After 2 years, market interest rates go to 7%, and after that, we'll expect market interest rates to fall again. And the swap rate is 6%. What are we doing now? Quite simply, we are trying to get a second swap. Now, we are getting 5%. We are swapping the 5% in t equal to 1 for the LIBOR, and then afterwards, after interest rates have risen to 7% in t equal to 2, let's call it RM, to 7%, we can now do a second swap for 1 year and get 6%. Now, this is now a risk-free fixed payment of 1%. No? This is actually quite nice because by doing these interest rate swaps, we've increased our fixed interest rate payment from 5 to 6%. However, this is nothing compared to an arbitrage, because you have to remember that you are actually doing those two swaps at 2 points in time, and this only works intertemporal and or intertemporally. And the critical point on which this is hinging is that interest rates have increased to 7%. And this only works if you are in luck. You have done a first swap, you are profiting from an increase in variable interest rates, And then at some point you say, okay, I expect variable interest rates to fall again. Now is the time to do a second swap and to make sure I'm keeping this profit. And this is how it works. It's not an arbitrage strategy, and this is not a risk-free. This is not a risk-free free lunch. Yeah.
So if you I'm not sure what this LIBOR means. So
LIBOR is the London Bank London interbank offered rate. It works like this: banks lend each other money on the interbank market, and the interest rates they are paying and receiving for those loans from one bank to another bank on a very short, with a very short maturity. Those banks publish those interest rates, and then the LIBOR is calculated, which is just, I think, the average of those interbank offered rates in London. You also have the Euribor, the European Union interbank offered rate. The LIBOR is not a pretty good example because it is now known that Deutsche Bank quite successfully manipulated it. What they did is because they are a major player in this market, they just published wrong interest rates. And they anticipated that by publishing wrong and slightly off offered rates, and telling the market, yeah, we've given out loans and we're taking on money at these and these offered rates, and they knew that by publishing not just 3%, but let's say 4%, that the LIBOR would go up or down. They traded on this, knowing that they can manipulate the interest rate. And it's not actually an interest rate, it's rather an average offered rate. Yeah? This is not one interest rate at which you can borrow money, but it's just like a stock index. It's an average of some interest rates those companies have published, and they have said that they have in other contracts taken on or given out these interest rates. And the LIBOR, just Google Deutsche Bank LIBOR, and you will find a lot of bad press on that.
Now if we have 7%, what's the market interest rate for the market, or is this, that doesn't mean that this LIBOR is 7% now?
This is meant to be the LIBOR, yeah? Yeah. The LIBOR and Euribor are just two examples of reference interest rates that are frequently used in interest rate swaps. You could have also used a Fed interest rate or a T-bill yields. You know? This is totally up to you, but standard swaps usually refer to the Euribor, for example. And then the LIBOR, the market interest rate, has increased to 7%, and then of course the swap rate will also increase. Okay. Now, the same can be done if you are expecting decreasing interest rates. And I don't want to go into the details here. It's quite interesting just to see that you can also use a so-called reverse floater. What is a reverse floater? A floater is something that pays out a variable interest rate payment. And what is a reverse floater? A reverse floater is an interest-bearing financial instrument that pays out, for example, 5 minus V, 5 minus V, 5 minus V. And it's called reverse floater because you are now, if you are long in the reverse floater, you're not profiting from an increase, but you are profiting from a decrease in the variable interest payment. And then, if you are expecting falling interest rates, you can buy a reverse floater, and you can also do something that is called an interest rate cap. Cap is just a contract that, now if, for example, you have a reverse floater, let's look at this, you are getting R2, and you're paying out RV, more or less, and with an interest rate cap, the buyer of the cap is receiving a percentage premium of a notional N from the seller. He's paying a premium and is getting an interest rate R%. Now, if a reference interest rate, for example, the 6-month Euribor, the Libor, is under a cap, you're getting 0. If instead the reference interest rate goes up, you will get the higher interest rate, but capped by our cap. So lower bound is our cap, and if the interest rate goes down, you're getting 0, and if it's up, you're getting V% minus our cap. And this is an interest rate cap. So in this case, you can combine all this. This is an interest rate cap. You're paying a premium, and you're getting R, and R is the maximum of RV minus R cap, or 0. And then you have the investor. He's paying out R1, and he's buying a cap from financial institution 2, so he's getting R, and he's paying out the variable payment in a receiver swap to financial institution 1, and then as a result you can cap and limit your payments here via this construction. So you can do any type of strategy with floating rate notes, coupon bonds, interest rate swaps, reverse floaters, and interest rate caps. But in the end, you are always interested in limiting interest rate exposure. And if you have some expectation concerning interest rate, market interest rates, you will try to speculate on this and try to exploit these expectations. Okay, so these are interest rate swaps, and you can also synthetically construct a bond. You can combine a fixed income product with a fixed floating rate swap as a receiver. You can also construct an interest rate swap, and this is shown here now with an insurance company. For example, the insurance company has a loan given out to a customer. You're getting a variable interest rate, and you're paying out the variable interest rate, and you're getting a fixed interest rate. And this, again, here, we've already talked about this. This is a T plus S forward swap. So you are right now here, and the swap contract only starts in capital T, and it runs until capital S, and then this is a capital or T plus S forward swap. And this is, I think, not correct, but it's the same construction as with the interest rate swap. It's just a forward contract. Okay. Swaptions. I've talked about swaptions already. Again, you can also distinguish a receiver and a payer swaption. It's the right but not the obligation to enter a swap contract. And it's a combination of a swap and an option. And not surprisingly, you have to pay a premium for the option, and actually the hockey stick diagrams for the swaption look pretty much the same like a plain vanilla put or a plain vanilla call. The difference just is now that the underlying price is what? It's the swap rate, because the underlying is a swap contract. So you don't have a stock price as the underlying price, but you have increasing and decreasing swap rates. And if the swap rate is beneficial to you and would cause a profit, then of course you would exercise the option. So you have a long receiver swaption or a short receiver swaption. Okay, and a long payer swaption, and it looks like a put and a call respectively. Okay. Now these are swap contracts and forward swaps and swaptions. And now let's turn a little bit to hedging. how you can hedge with futures and forwards. This is also very simple, actually. First example is we want to use a hedge instrument, more precisely a future, and we want to do a short hedge. We have a long position in, say, for example, a stock or a commodity. So we are in possession of 10 tons of steel, and we want to hedge against detrimental and negative changes in the steel price. Some notation: ST, capital T, KT, and FS. FS is the price of the future, KT is the spot price, capital T is the maturity of the future, and S is the point in time at which we've bought the future, and T is the point at which we are selling or closing the position. Now, if we are neglecting any interest rate payments on the margin account, the profit and loss position of a 1-to-1 short hedge is given by, we have bought, let's start here. We've bought our commodity, so we've paid out KS. We can sell it at point T, and we'll get the spot price for it. And we have bought the future, but actually we are going short, so it should be plus FS. And at the point of time at which we are closing the position, we will have, because we are selling the future right now, so we'll have an income now and profit now, we'll have to pay out and settle the future later on. So it's actually plus FS minus FT, but you can see that with this minus here, this is the same. And if you look at this, you will see that if we slightly rearrange it, we get FS minus KS minus FT minus KT, and this shows you that the profit and loss of this hedged position is the difference of the basis. So the basis in S minus the basis in T. For T less than capital T, so if we settle the position before maturity of the future, this is not a perfect hedge. We can see that actually if we keep the future until maturity, we cannot reduce the risk to zero. However, if we keep the future until maturity, if we let it expire, we know that the basis of the future will be, at this point, will be zero. So that the profit or loss is given by the basis you can observe on the market right now. And if you do this, if you do a short hedge via a future, you can completely eliminate any profits or losses from this long position in, for example, a commodity. This is how it looks like. You have the long position, you have the short position in the future, and you have a hedge position. If you keep it until T, capital T, you will have a hedge position at the level of the basis. Now, the basis, of course, can also be negative. So in some cases, if you can see this, it would be very simple to construct an arbitrage. So the basis will probably be not here in the positive. If underlying and future do not match, you have what we call a cross hedge risk. And in contrast to a short hedge, you can also do a long hedge. What is a long hedge? You have a planned but not yet existing long position in the underlying, and for this purpose you are buying the future. Now in this case it looks like this: minus KT minus KS plus FT minus FS is equal to now the opposite difference of the basis, BT minus BS. So again, you will not get a perfect hedge and you will not be able to reduce risk to zero, but your profit or your loss will be minus the current basis. And then here you have this hedging position. And you will have a deterministic loss at this level. Now let's analyze the effect of this hedge. We want to study the effect of the hedge in point S. We have N underlyings with current spot price KS, and we will buy X futures. So we are not exactly hedging one-to-one, but we want to study the optimal number of futures we are needing to hedge N underlyings. Now let's look at the profit and loss function here. We have N underlyings and X futures, and be careful that we are switching indices here. This is why it's highlighted in blue and red. And you can see that the profit and loss of this hedged position is N times KT minus KS minus X times FT minus FS. Now, if the future spot and future prices are stochastic, you can estimate and calculate the expected profit and loss and the variance of the profit and loss. And this is given by N times the expected future spot price minus the currently observable spot price minus X times the future price minus the current future price. And the variance is given by this. And now we can study here. We can try to estimate the number of futures needed for a minimum variance hedge. How can we do this? We simply take the variance, take the first derivative with respect to the number of futures, and then set it to 0. And we can see that the result will be 2x variance of the future price minus 2n the covariance of the spot and the future price. We set it to 0, and then we can see that the optimal number of futures needed for a risk reducing and a minimum risk hedge is n times what we call the beta factor. It's beta kf, for German Korrekturfaktor, n times a correcting beta factor. What is the beta factor here? The beta factor is the covariance between the spot and the future price, divided by the variance of the future price. So interestingly, and this is the important thing to remember here, is if we want to hedge N underlyings with a future without any cross-hedge risk, the optimal minimum risk and risk-reducing number of futures is not just N. It's not the 1-to-1 hedge. It's not the 1-to-2 hedge. It's actually, it depends on the covariance between the future and the spot price. And this correlation, more or less, between the future and the spot price determines the required optimal number of futures needed for a risk-reducing hedge here. Now, a risk reduction to 0 is not possible. You will always keep a risk in this amount here, or if we take the standard volatility, as standard deviation of volatility, it's n times the volatility of the spot price times the square root of 1 minus the correlation. In reality, correlation will be positive. You know? If spot prices go up, future prices will increase, and vice versa. Meaning that n times sigma of kt times 1 minus the squared correlation, and the square root of this, and this is quite simple. If this here, this correlation, rho is positive, then rho squared obviously is positive. Then 1 minus a positive number is 0. The square root of it will be less than 1. So we can simply write n times sigma times something that is smaller than 1. And then, of course, this is smaller than n times sigma. And this is how you get this inequation. You simply observe that rho squared is less than 1, and it's positive. 1 minus a positive number less than 1 is less than 1, is smaller than 1. And then the standard deviation of the profit and loss is less than n times the volatility of the spot price. Is that clear? You're still calculating the math. Klar? Yeah? Okay. Now, the perfect hedge, a risk reduction to 0, is only possible if the future and the spot price are perfectly positively correlated, and if the future price is then given by the cost of carry price. And if you also select the maturity of the future as your investment horizon, then you can get a perfect hedge. Then every euro you make with the underlying will be lost on the future and the other way around, but not in a different setting. This relation here, this ratio, the optimal minimum variance, the number of futures needed to hedge an underlying position, divided by the number of underlyings you are looking at, this is the hedge ratio. This is the hedge ratio. And if you have a look at risk management textbooks, you will find several different hedge ratios for different instruments and in different settings. And usually this is also done in theoretical risk management. There are actually, this was quite common in the 80s and 90s that economists and theoretical economists looked at financial markets and settings in which you now have a future and you now have an option, or you have a different risk management instrument, and now these economists try to calculate the optimal hedge ratio to get a perfect hedge. Okay. Now the expected profit of the hedged position is given by this here, and actually there's an error here. I don't know how this worked out. This is an error here. Now, if you are looking at the maturity of the future as your investment horizon, you will get a risk-free profit or loss, expected profit or loss, based on the basis, BS. At any previous point in time, T, and a correcting beta factor of 1, assuming that spot and future price are perfectly positively correlated, you will get N times Fs minus Ks minus this here. And obviously you can see what will happen is, if you wait until maturity, what will happen? Let's calculate this here, and you will see how this looks like for G capital T. Ft is what? It's equal to Kt, because of the convergence of the future price to the spot price. Then of course this difference here will become 0, and you will just get N times Fs minus Ks, so N times the basis. It's the same result as before, that of course if you have N underlyings and you keep the future until maturity, you will not have Bs plus or minus Bs, but you will have N times Bs or minus Bs as a profit. With a positive basis that does not increase, you will have a profit with a negative basis that doesn't increase, you will get a loss. And this is important to know, that based on the basis, you will get a profit or loss. Now, in future hedging, you also call this basis risk, the time evolution of the basis. And you have to keep in mind that just like with options, you can observe a theoretical, well, you cannot observe, but you know a theoretical price, the cost of carry price. You know that the future should, in theory, have this and this price, but you can also observe an empirical price. And the difference between the theoretical and the empirical price is what we call the basis risk. Why? Because empirical prices might not follow the theoretical cost of carry price. And if you hedge based on your idea of what the future price should look like in the future, that is the cost of carry price, and the empirical prices do not evolve in this manner, you will get what we call basis risk. Okay. Now this is hedging with options. You can also do hedging with futures. You can also do hedging with options, and we start with a 1-to-1 put hedge. You have N underlyings and you are buying N puts. Then at time T, capital T, you have your underlying, you have bought the put, and previously you have paid a premium for buying the put. So in summary, it will be ST plus the maximum of X minus ST or 0 plus P0. No, it has to be minus P0. And then, again, if you all combine it, you get X minus P0 and ST minus P0 for the stock price being above or below the strike. And if you have a look at this, you can see that this here is the underlying as a function of the underlying price. Quite clearly, if the stock increases by €1, your position increases by €1. This is the profit and loss for the option. You have to pay a premium, and then it looks like this. And if you combine it, you can take your underlying and you can hedge your position in this far left negative area. So previously with the underlying, with the stock, you would have lost everything here if the stock price had just decreased enough. But now you're tilting your position to this. And this is not a free lunch. Why? Because this here, you are hedging in this area, but you're giving up some of your profits in this area. And this is the effect of the 1-to-1 put hedge. You give up a little bit of profit just to make sure that if the stock price falls extremely, you are hedged via the put. And if you now include the price for the stock and the price for the put, it's actually the same, just a little bit further down the y-axis. Yeah? It starts now with S0, and previously it started here, but it just goes down a little bit because now you also include the price for the underlying. Yeah? But again, you can see that here, this is the effect of the hedge. No, sorry, and this here is the price you have to pay for it. You are neglecting some opportunities for a profit. Okay. Now, the 1-to-1 put hedge leads to an asymmetric profit or loss position at the end. You have some hedging, but you also give up some profits. If you take alternative strike prices, there's a trade-off between additional hedging versus reduced possibility to profit. If you take the put hedge, you can also try to hedge after you've bought the underlying. How can you do this? You simply buy an American option. Yeah, you can use an American option, and then you have a slightly different hedging effect, but this is also possible. Now, what are the requirements for this put hedge to work? First of all, you need a put. If you have a BMW stock and you don't have an option on BMW stock as its underlying, you have what we call a cross hedge risk. You need to buy the put at this moment, and buying a put later on will usually cause more costs, and you have to respect restrictions on your position, exercise limits, and then this can work. Now I will simply skip the next couple of hedging strategies because we now take not just one underlying but two options, or two underlyings and one option, and you will see the effect will be that previously we had this. Now with the 1-to-1 put hedge it looked like this. With the 1-to-2 put hedge it will look like this, and with the 2-to-1 put hedge it will look like this. So by including more or less options, you get a stronger or less strong tilting effect of your profit and loss function of your underlying. Now take a look at this. Here, this is the 1-to-1 put hedge. Again, I told you this is how it's tilted upwards. Of course, there's and I would say this would be the effect of a 1-to-1 put hedge. So you now have to pay more here, but you also have a stronger hedging effect. And the 2-to-1 put hedge is the opposite. You can see that now it is not as highly tilted as before, but it's not as costly in here. So these are some possibilities: 1-to-1, 1-to-2, 2-to-1 put hedge. Okay. Then you can combine some strategies. You can do what is called a 1-to-1 covered short call. You again have an underlying and you go short in a call. Remember that long put and short call are closely related to each other. And in this case, if you have a long underlying and a short call, it's ST plus the minimum of X minus ST plus C0 minus S0, and this is given by this formula. It's also sometimes called a call hedge in contrast to a put hedge. However, it is somewhat misleading because losses are not fully covered. Now let's look at this. We previously had the underlying long. We have the short call here, and the covered short call reduces losses here, and the price we have to pay is that with extreme increases in the underlying price, we are capped at some point, at some level here. So this is how a covered short call works. We are moving upwards, and here, this is the cost we have to pay. Because those are potential profits, and these are potential losses we're hedging against. This is a covered short call. Next, a collar. We have an underlying, and we go long in a put and short in a call with two strikes, X1 and X2. And you can imagine what will happen if, ideally, the prices of the put and the call are identical. It's also called a zero cost collar. And what will happen is you will get something like this. So you are giving up extreme profits in exchange for hedging against extreme losses. And if you have a zero cost collar, actually you have no costs. So here it will just be as the underlying, and you have your profits and losses capped below and up. Okay. Now, of course, this is the payout profile. This is the profit and loss profile. Again, this would be a zero cost collar. Okay. The collar can also be constructed by combining a one-to-one put hedge with a short call, or a covered short call with a long put. And there is even one additional special case. That is, if the strikes x1 and x2 are identical. Then, in this special case, you will get the value of the end position is x minus p0 minus c0 times 1 plus r taken to the tth power. And then there is a risk-free position at the end of the option maturity. So for the market to be arbitrage free, it needs to hold that Vt is equal to S0 times 1 plus R taken to the tth power. And this then can be translated into the famous put-call parity. You can see that C0 minus P0 should be equal to S0 minus X times X discounted with 1 plus R over T periods. Meaning, if you have a call and a put on the same underlying, the put-call parity in theory tells you that actually you can easily calculate the price of a put if you have the call price or vice versa. So if C0, the call price, is known, the put price is also known. And everything is observable. X, the strike is known, the interest rate is known, you know the maturity, and of course, if you know one of the option prices, you always know S0, the current underlying price, and you can calculate the put price from a call price or vice versa. This is the put-call parity. Now, if you have a heterogeneous portfolio, you can try to hedge against different investments, of course. You can buy puts on the individual portfolio constituents, or you can buy options on a stock index. However, this comes at a price. Usually, let's go one step back. Remember that there is no such thing as an index investment. By definition, a stock index is just a number, it's just a metric someone has calculated based on a number of stocks that are traded on a stock exchange. You cannot buy the DAX, you cannot buy the S&P 500. You can only buy the individual constituents in the with the respective weights. What you can do nowadays is you can buy, for example, an ETF, an exchange-traded fund. But what is this fund doing? The fund is buying the index constituents with such large capital and high capital amounts that it can offer you a share in this fund, and it can reduce transaction costs, and it can tries to passively, track the index. But at first you cannot buy an index. You need to buy the index constituents. Now, if you want to hedge against the DAX or the S&P 500 or the FTSE 100, you would need to do what? You could start by buying options against all those individual constituents, and this will bankrupt you due to transaction costs. Or you can try to buy options on stock indices. Those are traded. Those are available, but of course, it will produce some kind of hedge risk. You will probably not hold the index with the correct and right amount of numbers of individual stocks, and it might be that your options will not perfectly match your portfolio, even if you have those options on indexes and indices available. And your portfolio, if you haven't bought an ETF, as it will usually not perfectly track the index, you will have some hedge risk. And then you can try to do a beta correction. That is, you can, just like with the future and the beta factor there, you can try to estimate the correlation between your option prices and your spot prices of your portfolio, and then you can try to correct for the right amount of options you're needing. Okay, and this causes a hedge risk. You can then also combine options and a risk-free investment. For example, a fixed income product. Now assume you have capital K and you are investing K with K1 in the risk-free asset and K2 in a long call. Then of course K2 is just N times the call price, so you can buy N calls, and the terminal value of your investment is given by N times the payout profile of the option. This is the option. And K1 appreciated with the interest rate you're getting, IT. If instead you buy N puts, you get N times the payout profile of a put. In both cases, your investment is bounded below by the payout of your risk-free investment, and this is what is referred to as a cash and option strategy. Yeah, you are investing cash in a risk-free asset, in a fixed income product, and you are additionally buying an option strategy. Now, you can also synthetically construct a put. Now remember that even in today's financial markets, you will not find options on each and every underlying. For some stocks, for some investments, you will not see any options on the market, but you can synthetically construct those. How can you do this? Remember that the option delta, the sensitivity of the option price with respect to the underlying price, in the Black-Scholes model, this is the BS model, Black-Scholes model is given by minus N, the CDF of the normal distribution, at minus D1. And the put price can be represented by investing the capital amount X times discounted continuously with R times the CDF of the normal distribution at point minus D2, and going short in the underlying with the number of underlyings being N minus D1. And this, again, is the CDF, the cumulative distribution function of the normal, the Gaussian distribution. In English, CDF is what in German? CDF is nine. Yeah, cumulative distribution. Cumulative, referring to that you are summing up those probabilities. And this is what we call in German the Verteilungsfunktion. The Dichte, the density function, is the PDF, the probability density function. Yeah? So every time you hear of a PDF or a CDF, you know that the PDF is the probability density and the CDF the cumulative distribution function of, for example, the Gaussian distribution. And capital N of D1 is the CDF of a Gaussian distribution. And this is a synthetic put. You do not need an option, but you can take the Black-Scholes model and you can calculate the right amount of capital and the right amount of underlyings. You have to go short, and by combining these two, you get the same effect as you would with a put. However, of course, this is tricky. these two numbers here, for example, n and minus v1, this will never be an integer. An integer Ganzzahl. So you will never see I have to buy 5 or 6 stocks, but it will come out and tell you you have to buy 5.67 underlines, and this is not possible. So the hedge with such a synthetic put will never be perfect. However, what can be done is, of course, that if you are in need of an option and there is no option, you can go to an investment bank and ask the investment bank to draw up a contract in which you get the same effect for a price, and the investment bank will try to construct this. And because the investment bank is dealing in large volume, it can do so. So this doesn't make sense if you are doing it as an individual company, but you might be able to get this from an institutional investor, most notably an investment bank. This is what is done in financial engineering and structured finance and trading. The investment bank will offer you these investment products, and usually they will not sell you, well, they will do so, but they will not sell you simple stocks or bonds. In this type, in this area of investment banking, they will offer structured finance products. Yeah? And this could be done, for example, in a synthetic put. Again, this is the synthetic hedge. You can take the Black-Scholes price, and then later on you can see you will invest a certain percentage in the portfolio and a certain percentage in the risk-free asset. You have the same problems that are linked to the requirements and prerequisites of the Black-Scholes model, but again, this is just a simple application of the Black-Scholes price formula. CPPI, I will leave this out. Why? I've told you in the other lecture that one of my friends will take over the investment banking class, I think next year, and he's an investment banker with Deutsche Bank, and he once said they are offering CPPI, they are selling it like crazy, but they don't understand why people are buying it. They don't know why people and investors are buying CPPI, and it seems that this is quite frequently bought and traded in practice, but actually, at least from the standpoint of the investment bank, this doesn't make sense because you can do it in a different way. Just leave it out, and this will not be relevant for the exam. It's just one example of a structured financial product. I think it's more interesting to look at the discount certificates. Now, in structured products, structured finance, you're usually combining spot and derivative positions. And one example is a discount certificate. What is a discount certificate? You are, as the owner, you will get the value of a fixed number of stocks, and payment is kept per stock with a maximal amount of C. So the value of the structured discount certificate is given by VT is equal to N times the minimum of C or ST. So what is the difference to an investment in the stock? If the stock price increases too much, you will only get C. And if you have bought N certificates, discount certificates, you will get N times C. This is the difference. And you can see that although this seems quite simple, get the stock price or a cap, if the cap is lower, this can easily be transferred into this here. It's N times the underlying minus N times the maximum of ST minus C or 0, and again we see this is a simple call option with C as a strike. So to duplicate the discount certificate, you get stock and a short call, and the discount certificate securitizes the covered short call. So it's another word for covered short call. Guarantee certificate, Garantiezertifikat. What is this? The buyer gets the underlying as long as the underlying is higher than a guaranteed level G. So if the underlying spot price is lower than G, you will only get G. So it's the opposite of the discount certificate. It guarantees you a certain level of payment you will definitely get. And it's different. It's just quite the opposite of the discount certificate. You can see it securitizes an underlying and a long put. Okay, so these are guarantee certificates. What is an equity-linked bond? With an equity-linked bond, the issuer of the bond either has to pay back N or a previously fixed number of a stock. In contrast to a convertible bond, the issuer has a right to convert. Does everyone know what a convertible bond is? No? Convertible bond is a bond in which the buyer, the owner of the convertible bond, has the right to switch the bond, exchange the bond into a fixed number of stocks. And if the stock price is higher, it will switch from bond to stocks. In an equity-linked bond, it's the opposite. Not the buyer, but the issuer has the right to convert the bonds into stocks. So the cash flow stream of this equity-linked bond is Z, those interest rate payments on the bond, and finally interest rate plus the minimum of either N or N times the current stock price. And of course, the issuer will choose the notional that is lowest. If we have a notional amount of 1 million, but the stock is currently worth 90 euros, and we have 10,000 stocks, what are we doing? We can choose between 1 million or 900,000 euros, and we are only paying out 900,000, so we are paying out N times the stock price. So this is an equity-linked bond. And what can we do now to duplicate this cash flow stream? Well, we have the minimum of N and N times ST. This is N plus the minimum of NST minus N, or 0, and. And you can see here, this is N, the notional, minus the number of stocks times the maximum of N over N minus ST, or 0. And the cash flow stream is given by Z plus N minus N times the maximum of this. And you can see that you can duplicate the equity-linked bond by just a plain coupon bond with Z as a coupon and a short put on this stock as an underlying. By the way, you now can see why derivatives are important, why investment banks are so heavily trading on derivatives, and for what purpose they're doing it. Institutional investors will go to investment banks. They will ask for perfectly fitting hedging instruments and investment products. They will tell the investment bank, we want this or this cash flow stream, and the investment bank will structure these products by breaking it down into a usually small number of derivatives and bonds and stocks, and then it will trade on those derivatives and earn a fee by exploiting synergies and economies of scale by trading on those stocks and derivatives on its own. And in the end, any cash flow can be represented in such a fashion by a very simple combination of one or more derivatives and a very simple bond or stock. Okay, this is hedging. Do you have any questions concerning hedging? Quite simple. Please remember and have a look at those plots for the 1-to-1, 1-to-2, 2-to-1 put hedge, collar. Then of course you should know what a future, what a forward, what a swap, what a swaption is. And in the end, you should know how to construct those structured financial products. I think that's quite simple. If you know what, for example, an equity-linked bond is, you can even try to do it on your own, because I mean, this calculation, this is not This is not very difficult here. You simply have to switch and separate those minimum. Okay. So if you have no questions remaining, I think we stop here and we'll continue with option pricing next week. Okay, thank you.